So in this video, I'm going to talk about when can you actually start using a margin loan against your portfolio to fund things like your lifestyle, vacations, cars, whatever it may be. When is it actually safe to do so? Ideally, you want to use a margin loan to buy other assets in an ideal world, but there's many reasons someone might want to use their margin loan. But before you do it, you have to make sure a few things are met first. Few criterias. I would say typically the portfolio, once it's about $2 million, it has reached escape velocity. Of course, this depends on what you're invested in, and that is what we're going to talk about in the video, because it is vitally important before you even attempt this strategy that your assets are outperforming M2 inflation, not CPI. CPI is the cost of survival. You're not a survivor, you're a capitalist. So we are looking and measuring against M2 inflation. This is what is important. You shouldn't even be considering borrowing for lifestyle if your portfolio is less than 500k, right? Buy, borrow, die is for wealth extraction. It is not for wealth creation. Wealth creation is your investment choices, your investment vehicles. But buy, borrow, die is to let your winners continue to run, and it's more beneficial to use a margin loan than actually sell the stock and pay capital gains tax. So how do we make sure our assets are outperforming monetary inflation? Monetary inflation is usually around 7% on average. That's an average of the money supply over the last however 20 years or whatever. This means that the dollar loses about 50% of its value every 10 years. So if your assets are not outperforming this and you're borrowing against it, you're actually liquidating yourself slowly. This is why people are trying to copy a billionaire's strategy, but without using the billionaire's investment strategy. So people think they can just borrow against the S&P 500 and they think they're playing this game that the billionaires play. They think they've discovered some sort of secret when really they look foolish because they're just liquidating themselves slowly. Because if the S&P 500 does 10% a year and money supply 7%, your true returns are like 2 to 3%. If you're borrowing against that, you're in the negative. So do not do it. You cannot be a passive investor and try and copy buy, borrow, die. And there's so much false information out there on the internet right now on this topic. It seems to be trending right now, and people are given such misinformation because they believe that all assets are treated the same, and they're obviously not. So the portfolio needs to reach escape velocity. Usually happens around $2 million, and let's imagine it's invested in a big tech monopoly. The portfolio could be a balance of big tech monopoly and also some defensive stocks as well, which I will talk about. Now, the problem is going to be here. We need the volatile assets for the growth. However, if the assets are volatile, we're going to get margin called. So what do? We can't, how can we beat inflation but also not get margin called? This is what I'm going to talk about. So I want to just create a portfolio of $10 million. Gross portfolio is $10 million. You decide to borrow a margin loan of $1 million. The cost right now quoted is 4.39%. The portfolio needs to be growing around 20% year over year growth. Right, so it's growing $2 million a year, and the loan against it's only $1 million. So you would be stupid to sell this portfolio because it is compounding. And people always talk about compound growth, but where does compound growth even come from? Well, it comes from the money supply for a start. New money's always entering the economy, always entering the system. And the more that grows, the more these companies grow because they soak up like a sponge. Combine that with buybacks. The company buybacks its own stocks. This is where you get compound growth from. So if we don't want the volatility, we can also have a defensive stocks in the portfolio to protect ourselves from corrections and crashes because we do not want to get margin called. This is where we can look at defensive stocks. Now, a lot of people think, okay, if a defensive stock doesn't go up, let's say it doesn't go up 7% in the year, it hasn't even kept up with inflation, so we've lost money. This is false, okay? This is false. What we want to look at is what Warren Buffett taught us to look at, the owner's earnings. A company's stock price can be flat for a whole 12 months. Nothing's happening. Boring. We think we're losing money. We think we're losing to inflation. You're actually not. We have to look at the actual cash flow to find that information out. So I'm going to use an example of Waste Management. Waste Management is a boring company, boring defensive stock with low volatility, but the actual earnings, the cash flow right now is outperforming monetary inflation. It's just that the stock is not. Over the last 12 months, right before I made this video, it's 4.5% year-over-year growth. So 4.5% of nominal stock price change looks like we're losing. The truth is we're not, because the actual financial of the cash flow coming into the business minus its operating capital expenditure is actually growing by about 15 to 20%. So the company's growing, the stock price just hasn't changed. So as an investor, you shouldn't actually care about the stock price, you should care about the actual cash flow of the business. We only care about the stock price to stop being margin called, okay? Because it's Wall Street that really decide the prices of all the assets on the market. Retail investors probably make up like 15% of the investments on the stock market. Most of it's Wall Street. Wall Street decide the price, you decide the value. So what Waste Management is an example of a defensive stock that can actually outperform the inflation. We use the owner's earnings, not the stock price. So what this is, I call this like a coiled spring. It's a coiled spring, it's like a beach ball underwater. The market will eventually correct it and the stock price will catch up. See, Wall Street love to punish capital expenditure. Whenever a business reinvests in itself, the free cash flow goes down. And the free cash flow technically is what is the whole point of for a shareholder. That's where the shareholder's true return comes from, free cash flow. So Wall Street are going to punish companies that reinvest in themselves. They would much rather a company that did not reinvest in itself at all and the free cash flow was high. Wall Street would be like, this is great, the free cash flow is high, but the company isn't reinvesting in itself, which means it's slowly going to lose to competition. The capital expenditure should not be punished because it's a way that the company is reinvesting in its growth. So it should be viewed as a positive thing. Warren Buffett and Charlie Munger knew this. That's why they used operating cash flow, so the actual cash into the business minus the cost they spent on maintenance of the actual payments of depreciating assets in the business. So that's what we want to look at. Now, a great example of the coiled spring approach is Microsoft. Look at Microsoft between 2000 and 2013. For 13 years, the stock price was flat and boring. However, the revenue tripled, and eventually the market catches up and the price will correct it. So what you should be, if you're looking at defensive stocks, any stocks in general, if you're looking at them, you want to look at if the owner's earnings is growing year after year. That is what's the true value in the company. Everyone has a different opinion on this, but I can see the logic in it. I can see why Warren Buffett used this terminology, because it makes sense. Because if we just reward companies that do not even reinvest in themselves, like, what is the point? We're punishing companies for being competitive and planning ahead for the future. So this is serious, the red pill view of finance, because people are comparing their assets to the cost of survival, and this is a lie. This is what consumers use. This is what survivors use. We're not survivors. We're capitalists on this channel. We measure against the money supply inflation. That is the inflation that matters. You should not be borrowing against assets that do not outperform this. This also applies to real estate. Real estate, people think all real estate goes up. This is another lie. It doesn't. Only prime real estate, prime locations that defeat the money supply. They must grow faster than the money supply. You see, you have people that have real estate, they think, oh, it's went up 10% this year. It's actually just kept up with the money supply. More dollars were issued into the economy, all the assets have went up the same, and they think that they're going up, they're beating inflation when they're actually just matching it. Okay, this is vital to understand, because you're now going to start to understand why people are basically losing the game, right? They're losing the game because they don't know the rules of the game. And that's what we are talking about on this channel. See, people are in such a aggressive rush to pay off cheap debt, and it's actually mathematical suicide. This is the type of stuff that the blue pill finance teach, the Dave Ramseys of the world. They are teaching people that have like the financial literacy of a child, who have no control, have no understanding. He's actually teaching a behaviour. It's not maths, it's just behavioural psychology. Because mathematically, if your mortgage, for example, is cheaper than inflation, true inflation, and you're aggressively paying that, and someone's aggressively paying that off, they're actually just shooting themselves in the foot. Because realistically, the bank is actually paying them to live in the property, because they're losing to the inflation. So everyone's got their own opinion on this as far as the psychology behind it, if it's like an emotional thing, but the maths is very clear. Okay, the maths is very clear. This is why this strategy exists. This is why buy, borrow, die exists, because you can see we're focusing more on the assets growth, the compound growth, and not interrupting that, allowing that to continue. Okay, so more videos coming as always, and if you're happy, leave a comment if you want to ask any questions on the strategy.